Welcome back, everyone, to the continuation of the Forex Trading Beginner Series. In this lesson, we're going to be discussing what exactly a lot in Forex is. So for those of you guys who have never traded Forex or know nothing about this market at all, then you're just not going to know what a lot is until we get through this lesson. So a lot is going to be basically the amount of currency that you're going to purchase as a standard amount normally that you would purchase in either a buy or a sell order trading Forex. So we'll get more into the different types of lots and everything like that. And then, of course, some examples for you guys to go ahead and look at so you understand them a little bit more in depth. But again, this course that we're doing is modeled after the babypips.com educational curriculum. So for those of you guys who would prefer to read it or just want to check through the actual website to review these lessons after you watch them, go ahead and go down in the description. We're going to leave links to all the corresponding pages that we do go over in these videos over to the website on babypips.com. So of course want to shout them out because they do have a great free educational curriculum that we're modeling after for at least the free or the beginner part of the content here on the channel. And then we'll get into some advanced things, some things that are tailored to specifically my trading strategy and some of the things that I've learned along the way of my trading journey of 4 or 5 years now. So moving on into what a lot is in Forex. So before the advancement of retail Forex trading, spot Forex was only traded in specific amounts called lots. So again, lots, basically the number of currency units you will buy or sell. So the standard size for a lot, which again used to be the only thing you could purchase, is 100,000 units of currency. But now there are also mini, micro, and nano lot sizes. So there's actually some smaller lot sizes than nano, but we're not going to really talk about those or get too concerned with those, because if you're looking to purchase lot sizes that are nano or even smaller than that, you should probably just be paper trading and practicing your skills until you can save up enough money to at least be playing around with micro lots or even mini lots. So continuing on, what is a lot in Forex? This just gives you a better idea about the number of units that are contained within each lot size. So a standard lot would be 100,000 units of currency. A mini lot would be 10,000 units of currency. A micro lot would be 1,000 units of currency, and a nano lot is 100 units of currency. So again, these are the different lot sizes that are the most common. If you guys really want to, you can start off trading with a nano lot size with a small account. But again, I wouldn't really recommend that, as a lot of the top brokers, the safest and most secure brokers that you should be using, are not going to offer those necessarily. But you can find good brokers that do offer them if you really want to start off trading with a small account like that. But again, you shouldn't be trading until you've educated yourself, put some effort in on the side of paper trading for a good amount of time, and actually proving yourself to be consistent and profitable. So moving on, again, what is a lot? In order to take advantage of the minute change in value that we've already reviewed called pips. So again, pips are those moves that are going to actually allow you to be profitable. Instead of thinking of profiting in Forex by percentage point, you think of it as pips. So you need to trade large amounts of a particular currency size in order to see any significant profit or loss relative to your account size. So assuming we will be using a 100,000 unit, which is a standard lot size, let's go ahead and take a look at how much profit or loss you will accrue per pip. So this again is a table from babypips.com. You guys can see here that it breaks it down really simply and really easy with two different types of pairs. So again, we reviewed the pip count in the previous videos. So for example, we have the Euro USD and the USD JPY pairs. And we can see here for a standard lot, the profit would be $10 per pip, or for USD JPY, $12.50 per pip. And you guys can go ahead and see what the pip values are for the rest of them. But I want to make a note here that basically per pip is going to mean, let's say average, just off the top of my head, for like a London session or for the New York session, the average pip value or change, the amount of pips that you'll see in a session for Euro USD, for example, is normally going to be anywhere from 20 to 40 pips. Of course, it can be more than that, but let's say you're trading a standard lot. If you're going to see a 20 pip move, that's again going to be $200 profit. Or 40 pip move, $400 profit. Of course, some of the pairs I trade, you're going to see oftentimes average 40 to 80 plus pips per session. And again, we'll talk about some of the more unique aspects of my trading strategy and what pairs that I try to focus on mainly that allow for a little bit more profit. Of course, you need to understand how to trade them, but if you're getting 40 pips and it's a $10 per pip value, that's $400 profit. So that's over 6 figures per year trading. But again, you have to be able to work up from that. And the way you do that is, of course, starting off with, let's say, micro lots, mini lots, and then moving yourself up to standard lots, and then eventually being able to purchase multiple standard lots and really be able to run up your profits depending on the account size, of course, risk management, and everything like that. So just giving you guys a little bit of a peek into what is possible with Forex and how the profits actually work out and the numbers behind each, just two of the most common pairs, Euro USD, USD JPY, and how you can actually make those profits. So leverage, I want to discuss this real quick in this video because if you're a small investor, you may be wondering how you'll be able to make any significant profit or trade with large amounts of money. So think of your broker as a bank who basically fronts you $100,000 to buy currencies. Okay, so you guys don't need, let's say you're buying Euro USD or a different pair. You don't need $100,000 to be able to purchase 100,000 units of that currency, because the bank or your broker, you should view them as a bank, is going to lend you the money per trade. So all the bank asks from you is that you provide $1,000 as a deposit, which it will hold for you, but only keep if things go terribly wrong. And of course, we're going to make sure that doesn't happen with risk management and cut our losses before anything extremely bad like that happens, losing your entire deposit for a trade. But again, you shouldn't be trading any more than 1 to 2% of your total account size on any single trade. A lot of times even less. And before even trading, you should be paper trading and proving yourself profitable first. So I just want to make that a point. Again, this is going to be 1 to 100 leverage. We'll talk more details on leverage later, but just keep that in mind. So to be able to profit, let's say you purchase a standard lot of Euro USD and you see a 40 pip move. That's $400 profit, and you only put into the trade of your own money $1,000. So you're controlling 100,000 units of currency. So you're thinking, oh, well, $400 isn't, that's not a lot of profit percentage-wise on $100,000. Well, it's not your $100,000. It's actually a 40% profit on the money that you put into the trade. So you're making 40% on your money. Again, you're using only a small fraction of your total account size, but when you view it as a percentage gain, if you put in $1,000 for a trade and you're getting $400 back on that trade, that is a 40% gain. So that's why Forex trading can be extremely profitable once you know what you're doing. But you have to understand how to work with all of the different moving parts of Forex and be able to navigate the market successfully. So it is a difficult market to learn, as any market is difficult to learn. But once you do get the hang of it, it can be extremely profitable. So if this does sound too good to be true, it's just not. This is how Forex trading works, and every single broker is going to offer you leverage. And 1 to 100 is actually pretty low, low to medium, I would say, for leverage. A lot of the US brokers will only offer, because it's only legal to offer 1 to 40 or 1 to 50 leverage. So for example, for this trade, if you're going to buy 100,000 units of currency or $100,000, you would need $2,000 or like $1,800 or something like that. So again, $2,000 if you made $400, that's almost 25% still, and that's on one trade. So this trade could literally happen within a day, And that's why Forex trading is one of the most profitable markets to navigate, along with many other factors as well that add into that. So again, this is how it works. Leverage is a main aspect of Forex. If people weren't allowed to use leverage on every single trade, then people simply would not trade Forex. If you had to put in $100,000 just to make $400, for example, or $200 even, sometimes it's only going to be a 20 pip move or even a 10 pip move for a lot of you guys that may start scalping. Or even if it was a 100 pip move, if you're only able to make $1,000 on $100,000, what, you're going to make a 1% gain? I mean, and that's an anomaly because there's not going to be a 100 pip move every single day. So that is why Forex trading is so profitable. And one of the key aspects of it is, of course, leverage. And that's how it works. If it does sound too good to be true at first, you will see that that is how the market operates once you actually get into trading. So the amount of leverage you use will depend on your broker, but most importantly, what you feel comfortable with. So typically the broker will require a deposit, also known as margin. Once you have deposited your money, you will then be able to trade, and the broker will also require specific amounts of margin per position traded. So an example, if the allowed leverage, as we talked about just now in this example, is 100 to 1 or 1% of position required, and you wanted to trade a position worth $100,000, but you only have $5,000 in your account, you're able to trade that $100,000 with only $1,000 set aside by your broker as a deposit and lets you borrow the rest, which of course is leverage. So $1,000 is not a fee. You're not going to lose that money. It's a deposit on the trade. So you get that back when you close your trade out, assuming you profit or at least cut your losses and didn't lose too much of that money. So of course, if you just put the $1,000 in, forget about it for a week, and the trade went the opposite way within the first 10 minutes and you had no idea, yeah, of course you could lose that a whole $1,000, but that's just like in any other market. If you buy $100,000 of a stock and the stock goes from $50 to $2, you're going to lose a bunch of money. That's just how markets work, and you have to build in risk management, strategy, and a trading plan, all different sorts of things that we're going to discuss later on. But a lot of people see Forex as a market that's scammy or different words that are negative to describe the market, and a lot of that has come from multi-level marketing and things like that have kind of ruined the look of Forex over the last couple decades. But hopefully with this channel and with the content that I provide for you guys, going to start to reverse some of that thinking about the market, because it really is one of the most profitable markets to trade in my opinion, and honestly one of the more easier ones to comprehend, because for example with equities markets, there's a lot that goes into understanding the fundamentals of a company. In my opinion, currency trading is a little bit more simplified. It is still difficult to understand and get going with and really master your trading skills, but that comes with any market. But the fundamental wise, I think even technically wise, Forex is a market that is a lot easier to learn and to be good at than any other market. So I wanted to kind of touch on that a little bit, because I know there are a lot of negative aspects associated with Forex from over the years. But a lot of that, again, comes from how people view it because of multi-level marketing and things like that. So I hope you guys enjoyed this video, again, going over what exactly a lot is. And make sure you guys review this video. Go down in the description and go to babypips.com if you guys want to read through this lesson, and just make sure you don't miss anything, because of course this lesson is going to be very important, understanding leverage and the different types of lots and everything that goes into that. So hope you guys enjoy this video, and we'll see you guys in the next one.